Stock futures are higher. All the attention, however, remains on some of those heavily shorted names, seeing a lot of pressure in that space this morning. And let's stay on everything that's happened in the markets of late. Jeremy Bryant joins us now. He's a senior portfolio manager over at Gradient Investments. So, Jeremy, let's just start with how you're thinking about what we've seen the last week or so. Not so much does it change your view on the market, but do you think these kinds of retail bids are here to stay and something that you need to think more seriously about as part of your process?
To be honest, no. In my opinion, I have no idea how long it's going to last, and what it will rotate into next. Our concern is much more, and our philosophy and process kind of has stayed the same, right? At the end of the day, we're not going to chase these kinds of things just simply because they're going up aggressively. We monitor business fundamentals and businesses in general, and this really doesn't fit with that in that regard. But where I do look at this and where we're paying attention to is let's say we do have an issue where, you're going up the elevator and then down the elevator, right, for these stocks. Does that bleed over into the more traditional stocks, your Intels, your AT&Ts, your Home Depots of the world? Do people get concerned about the markets in general if these retail names that have been chased up very aggressively begin to correct very aggressively as well? So that's what we're a little bit more cautious about. We want to understand how that works and if that becomes the case. But it'll also provide some opportunity if that's the case, if things get overly cheap because of that.
And just wanted to mention we are, of course, looking at the opening bell. Zim Integrated Shipping ringing the bell this morning. Jeremy, a lot of the stocks, I think all of the stocks that have been involved in this whole short squeeze trade have been small cap stocks. And I know you guys are kind of shifting your positioning a little bit on small caps. Does it have to do with what's been going on, or is it more just general performance?
More general performance, but this trending has been a little bit. It started in September. Is that we got overweight in small caps in around that area, September, October area, because there was a very large dispersion of performance at that time, where large caps were really dominating the performance. That corrected itself really quickly. Usually these things play out over maybe even 1 to 2 years, or usually at least 6 months, but in this instance, that correction in the small cap stocks really happened fast, and valuations and performance have not only caught up, but they've superseded that of large caps at this point now. So especially in small cap growth, we're a lot more cautious than we were before, but we just thought it was prudent to pull that back after having some outperformance as a result of our call there, which we were happy about. We just don't see it. It's more of a continued momentum play now than it is a reversion to the mean or a catch-up trade. And we just don't know if that's there, considering a lot of the small cap stocks are trading at over 30 times earnings now. So they're expensive. They've gone really far, really fast. I think it's just prudent to take a little bit off the table now.
Jeremy, GameStop shares hit a intraday high late last week during the frenzy, about $438 a share. Right now, I'm looking on the Yahoo Finance platform. The stock's at 150. I mean, do you think that type of pullback is a buying opportunity?
No, I mean, I don't. I don't, look where it was a few months before that. It's what we look at is it has the business changed. I think in this opinion with GameStop and with some of the other stocks that we're seeing out there, I don't think anything fundamentally has changed with regard to the companies before this started or right now. So in that regard, I mean, in our opinion, it's better to just really just ignore these stocks for the most part, these ones that are having parabolic moves, because trying to time this from that perspective, in our opinion, usually ends up more in pain than in prosperity. So in that regard, there's a lot of different stocks out there that have strong fundamentals that are trading at reasonable valuations that we can take a look at. And we prefer just to kind of stay out of the fray of the GameStops of the world, because frankly, we can't assign value to this because we don't think the movements that are happening in these stocks have anything to do with fundamental value of the business at all.
So, Jeremy, we've talked a lot about things you don't like. What do you like in this market right now then?
Yeah, great question. Really what we've been going back to is what's still relatively cheap out there. And the two areas that we're seeing is that real estate is one. In a regard of what we're looking at right now is a higher probability of interest rates. That's of interest rate rising over time. We think that that's a higher probability. And if you do get stimulus measures and you get subsequent inflation as a result of that, usually asset prices rise as long as it doesn't get out of hand. And in that case, real estate should look pretty good during that period. So we like that positioning. We like secular growth names in there, like the towers and the data centers. We think those are just good plays. They were recovery plays before, and so they've subsequently corrected pretty hard. We think now is a pretty good opportunity to get involved there, and we actually have positioning there now. The other ones we really like, just from a perspective of valuation and under that same kind of economic growth, potentially higher interest rates, is financials. I mean, they've had a pretty decent run. They've pulled back a little bit, but they've had a pretty decent run, but they're still at 12, 13 times earnings compared to a market at 20 plus earnings, so we think there's still an opportunity there if they can grow earnings in the double digit range over the next couple of years based upon just loan loss provisions coming down, better earnings, better loan growth, these kinds of things. We still think there's an opportunity there as well.
All right, Jeremy Bryan is a senior portfolio manager over at Gradient Investments. Jeremy, always great to get your thoughts. Thanks so much for joining the show this morning.
Thanks for having me. Appreciate it.